$700 silver sounds crazy, right up until you stop looking at silver like a sleepy little metal and start looking at the pressure building around it. Because this is not really a story about one price target. It is a story about supply that does not move fast, demand that refuses to go away, a debt machine that keeps expanding, and a market structure where most people still do not understand what they are holding. That is why this conversation matters. And that is why, if you stay with me all the way through this, the numbers stop sounding like a joke and start sounding like a possibility. And before we go further, I have to say this because the stats keep showing the same thing over and over again. A lot of people watch, but far fewer actually subscribe. So if you get real value from these breakdowns, subscribe to the channel, join the WhatsApp channel for the fast updates, and leave one quick comment, even if it is just "Our John AG," because that small action helps this content reach the people who actually need it. Now, this is not a promise that silver goes vertical tomorrow. It is not a claim that next week you wake up and silver is suddenly at some insane number. And it does not mean the path will be clean, because it probably will not. As of April 6, 2026, spot gold was around $4,691.86 an ounce, and spot silver was around $73.21, which puts the gold to silver ratio near 64-1. That alone tells you the market is still pricing silver very cheaply relative to gold, even after silver's huge move over the last year. So the real question is not, can silver go up a little more? The real question is, what happens if gold keeps climbing, silver keeps staying structurally tight, and the ratio between the two starts compressing in a serious way? Because that is where people stop thinking in $10 moves and start thinking in life-changing moves. And once you see the setup through that lens, the whole picture changes. But first, I want to talk about the thing most people still do not want to look at clearly: the broad stock market, especially the AI-heavy part of it. Because whenever money gets too concentrated in one crowded corner, risk starts building in silence. Reuters reported last year that the S&P 500 technology sector had recently reached 33.9% of the entire index's market value, the biggest share since March 2000. Then later, Reuters reported the tech weight had climbed to 36% of the S&P 500, even higher than the dot-com era. That kind of concentration is not automatically a crash signal, but it is absolutely a warning sign. And why does that matter for silver? Because when the market is top-heavy, people start thinking they are diversified when they are not. They are actually tied to a handful of giant names, a handful of giant narratives, and one giant theme. If that theme gets wobbly, capital starts hunting for places it ignored. It starts hunting for things that are hard, real, scarce, hated, or underowned. Silver lives in that category far more than people realize. That is why I do not even need a full collapse in tech to make the silver case interesting. I do not need the NASDAQ to go to zero. I do not need the S&P to break in half. All I need is a change in relative preference, a change in where capital wants safety, a change in how money values hard assets when paper assets begin to feel too crowded, too expensive, or too fragile. That alone can move silver a lot faster than most people expect. Now let's get to the first pillar of the argument, because this is where the discussion stops being emotional and starts getting structural. Gold and silver do not come out of the ground in anything close to the ratio the market prices them today. The World Gold Council said global mine production reached a record 3,672 tons in 2025. The Silver Institute said 2024 silver mine production was 819.7 million ounces. When you convert the gold number into ounces and compare the two, you get roughly 6.9 ounces of silver mined for every ounce of gold. Call it about 7-1. That is a huge gap from a market price ratio sitting around 64-1. Now, slow down there, because I do not want to oversell that point. Mine ratio is not the same thing as price ratio. The market does not just look at what comes out of the ground and then stamp a neat little price formula on top of it. That is not how markets work. One metal is held differently. One metal trades differently. One metal is hoarded differently. One metal is used differently. So no, I am not saying silver must trade at 7-1 with gold tomorrow morning. What I am saying is simpler than that. If something is being mined at about 7-1, but priced at around 64-1, you would better have a very strong reason for why that gap should stay so wide forever. And once you start digging, that reason gets weaker, not stronger. Because silver is not just sitting around waiting to be admired, it is being used. And that brings us to the second layer. The Silver Institute said industrial silver demand reached a record 680.5 million ounces in 2024. Not only that, it said overall demand exceeded supply again, creating a structural market deficit of 148.9 million ounces for the year. So this is not some sleepy metal with no real-world pull. Silver is going into electronics, electrification, grid systems, solar applications, and AI-linked consumer electronics. The market is not just trading silver. The real economy is chewing through it. And if you want to understand why that matters, here is the simple version. Total silver demand in 2024 was 1.16 billion ounces. Industrial demand alone was 680.5 million ounces. That means close to 59% of all silver demand came from industrial use. So when people talk about silver like it is only a shiny little inflation hedge, they are missing almost the whole story. It is a monetary metal, yes, but it is also a working metal, and that dual role is exactly why it can get explosive. Now here is where it gets even more interesting. In 2026, the Silver Institute still expects a sixth straight structural market deficit. Reuters reported that the current preliminary estimate is a 67 million ounce deficit for this year. Industrial demand is expected to cool a bit, down 2% to 650 million ounces, because manufacturers are trying to thrift, substitute, and use less silver where they can. But physical investment is expected to rise 20% to 227 million ounces, while total supply is only expected to increase 1.5% to 1.05 billion ounces. Mine production is seen up just 1% to 820 million ounces. Recycling is expected to rise 7% and finally push above 200 million ounces. That matters because it tells you two things at the same time. First, yes, high prices do create some response. People recycle more. Engineers try to use less. Some demand cools. That is real. But second, even after you count that response, the market is still projected to stay in deficit. That means the silver story is not some one-sided fantasy where demand rises and supply does nothing. The real story is that supply does respond, but not nearly fast enough to fully erase the pressure. And that is exactly why silver can move in a violent way once sentiment catches up. Because higher silver prices do not magically create new silver tomorrow. Mines are not apps. You do not just update the software and double output next week. You need deposits. You need financing. You need permits. You need years. Sometimes many years. And silver has an extra problem on top of that. A lot of silver is not mined because companies went out looking only for silver. A large chunk of global silver supply comes as a byproduct of mining for other metals. So if silver rises sharply, that does not always mean silver supply can instantly surge to meet it. If copper, zinc, or lead decisions drive the mine, silver is along for the ride. That makes silver supply less flexible than people think, especially during fast demand shifts. This is where many investors make a huge mistake. They look at the price chart and assume supply must be elastic. They assume, well, if silver goes high enough, miners will flood the market. Maybe eventually. But between now and eventually sits a long chain of delays. Financing delays, construction delays, energy delays, political delays, environmental delays, market delays. And that is before you even ask whether the next generation of projects is truly strong enough to change the whole picture in a meaningful way. So when somebody asks, can silver really move that far? I think the better question is, what is the market going to use to stop it if the monetary demand returns while industrial demand stays stubbornly large? Because right now, the answer is not obvious. Not when the market is already coming off multi-year deficits. Not when supply growth is still small. Not when higher prices have not solved the core tightness story. Now, do I believe gold matters in this conversation? Absolutely. Gold is the bigger train. Silver is the faster car attached to it. Gold usually gets the trust bid first. Gold usually gets the central bank bid first. Gold usually gets the big institutional nod first. Then silver starts noticing. Then silver starts running. Then people who ignored silver begin chasing it. And that is usually when things start getting emotional. And gold still has serious support behind it. The World Gold Council said central banks bought 863 tons in 2025. That was lower than the 1,000 plus ton pace of the prior 3 years, but it was still historically elevated. The same report said gold mine production hit a record 3,672 tons in 2025. So even with record mine output, demand stayed strong enough for central banks to keep adding in a big way. That is not a small detail. That is a sign gold is still being treated as a reserve asset in a world that does not fully trust paper promises. Then you add the bank targets. Reuters reported that UBS raised its gold target to $6,200 for March, June, and September 2026, while seeing $5,900 at year-end, an upside scenario of $7,200, and a downside case of $4,600. So even one of the world's biggest institutions is not talking about tiny moves anymore. It is talking about gold in ranges that would have sounded ridiculous not very long ago. Now think about silver under those kinds of gold scenarios. If gold reaches $6,200 and silver only trades at 30 to 1, that is roughly $206 silver. If gold is $6,200 and the ratio compresses to 20 to 1, that is $310 silver. At 15 to 1, you are around $413. If gold reaches UBS's upside case of $7,200 and silver trades at 15 to 1, you are around $480. And if this whole cycle ends in a much bigger currency reset, where gold eventually touches something like $10,000 and silver gets to 14 or 15 to 1, now you are suddenly staring right into the edge of that $700 zone. That is why I do not treat $700 silver as a base case number for next month. But I also do not laugh at it, because mathematically, structurally, and historically, it is not some impossible fantasy number floating in outer space. It sits at the far end of a chain that requires much higher gold, much tighter ratios, and much bigger stress in the monetary system. Extreme? Yes. Impossible? No. And that distinction matters. Now let's talk about the monetary system, because this is the part people keep pretending can be postponed forever. The debt story is not getting smaller, it is getting larger. Reuters reported that the Congressional Budget Office expects the U.S. budget deficit to grow to $1.853 trillion in fiscal 2026, about 5.8% of GDP, and then rise to 6.7% of GDP by 2036. The CBO said those large deficits are historically unusual, especially with unemployment projected to stay below 5%. That is not a healthy, normal path. That is pressure building in plain sight. And then Jerome Powell went to Harvard and said the current debt path is not sustainable. Those words matter because they did not come from a gold bug, not from a silver stacker, not from a fringe newsletter, but from the chair of the Federal Reserve. When the man at the center of the dollar system is using language like that, you should at least pause and ask what kind of long-term environment precious metals are being born into. Because once deficits stay large year after year, the choices get uglier. You can cut spending hard, which politicians hate. You can raise taxes hard, which voters hate. You can accept higher inflation, which savers hate. You can let debt service eat more of the budget. Or you can try to manage the whole thing with financial repression, lower real returns, and a currency that quietly loses buying power. Precious metals do not need every one of those outcomes. They only need enough of them. And this is where I want to make it simple. A lot of people hear words like real rates, debasement, or monetary reset, and they tune out because it sounds technical. But the basic idea is not complicated. If your money in the bank grows slower than the cost of living, you are moving backward in real terms. You are being taxed by time. Gold notices that. Silver notices that too, except silver usually notices it later and then reacts much harder. Now layer geopolitics on top of that. On April 6, Reuters said gold was trading around $4,691.86 and silver around $73.21, while markets were watching war headlines, ceasefire talk, oil above $107, and changing rate expectations. The same Reuters report noted traders had almost completely priced out any Fed cuts this year compared with before the Iran war began. That is exactly the kind of unstable background that creates confusing short-term moves in metals. Oil up, dollar moving, yields reacting, war risk shifting by the hour. And this is why I keep saying silver will not move in a straight line, because short-term panic can hit everything. In a broad liquidity scare, even precious metals can get sold. Not because the thesis is broken, but because people are forced to raise cash. That is how markets work in the real world. That is why anyone trying to trade silver like a smooth, polite chart is usually asking for pain. Silver is not polite. Silver is emotional. Silver can drop hard enough to make you question everything, then rebound fast enough to make you feel sick for selling. That is why I do not like the idea of treating silver as a quick, rich instrument unless you are truly built for that volatility. Most people are not. Most people think they want volatility until it actually arrives. Then they discover what it feels like to watch a position move against them faster than they expected. And let me say something that needs to be said clearly. If you are only buying silver because you think it is going to pay your rent next month, you are probably setting yourself up for disappointment. If you are buying it because you understand debt, currencies, deficits, industrial demand, and long cycle repricing, that is a different mindset. One mindset panics at every pullback. The other mindset asks whether the bigger structure changed. Those are not the same investor. This is also why stories of people getting trapped at the top keep repeating in every market cycle. People get excited late, they buy the strongest candle, they average down without a plan, then they start asking why price always falls right after they buy. That is not a silver-only problem. That is a human problem. The market feeds on impatience, it feeds on emotion, and silver, maybe more than most assets, punishes people who confuse conviction with recklessness. So, if you are one of the people who has been navigating this space well, genuinely well, share that in the comments once in a while. Not to brag, to help. Because a lot of people read those comments quietly. A lot of people need to hear from someone who stayed disciplined, thought long-term, and did not get shaken out by every ugly week. Success stories from real viewers can lift the confidence of people who are still trying to learn how to move correctly in a market like this. And while we are here, by the time you are watching this, the members-only video should already be live. If you want the full picture in one place instead of piecing updates together, join the membership and watch that upload, because that is where the deeper breakdown is. Premium members are going to get the more in-depth analysis going forward, and frankly, that also tells me who is really following closely and who just wants the quick headline. Now, let's come back to valuation, because this is the part that can get explosive without requiring magic. Silver does not have to become the center of the universe to move much higher. It only has to stop being treated like an afterthought while stocks remain crowded. If the biggest part of the equity market stays expensive and concentration remains elevated, even a modest rotation toward hard assets can move silver faster than people think, simply because the silver market is small compared with the amount of capital that could chase it. That small market point matters. Gold is deep. Silver is not nearly as deep. Gold can absorb bigger flows more calmly. Silver gets pushed around harder. It gets squeezed harder. It gets overbought faster. It gets washed out faster. And that is why silver can be the metal that looks boring for a long time, right before it stops looking boring all at once. Now here's another angle people keep missing. Silver does not need the NASDAQ to collapse for silver to equity value to improve. The ratio can change because silver rises faster. It can change because tech cools while silver holds steady. It can change because both rise, but silver rises much more. This is why relative valuation work matters. It keeps you from thinking there is only one path to a bullish outcome. That is also why the current market setup feels so strange. On one side, you have still powerful AI spending. Reuters reported that big tech's planned AI infrastructure spending for 2026 was expected to hit $635 billion, up sharply from prior years. On the other side, Reuters also reported that tech stocks had started to wobble under war stress, energy cost risk, and valuation pressure, with the S&P 500 tech sector down nearly 8% since the Iran conflict began. So the market is already telling you something important. Excitement is huge, but fragility is huge too. And when excitement and fragility live together, rotations can be violent. The same crowd that piled into one trade starts searching for the next one. That does not mean every tech stock is doomed. It means concentration risk exists, and silver is still small enough that a relatively modest change in preference can feel massive on a price chart. Now let's talk about the global demand side a little more, because people sometimes think silver is just an American retail story. It is not. The Silver Institute said China accounted for the largest share of industrial gains in 2024, with a 7% rise, while India recorded a 4% increase. So the industrial story is not coming from one corner of the world. It is broad. And even in 2026, when some categories are expected to soften, the market is still forecast to stay in deficit. That matters because it means the silver story is not built on one buyer, one country, or one single emotional trade. It is built on multiple streams of demand crossing at once: industry, investment, monetary stress, relative value, limited supply response. And every time a market has multiple supports instead of just one, it becomes harder to kill the thesis with one ugly week or one scary headline. Now, I also want to be fair here. There are things that can slow silver down. High prices can hurt jewelry demand. High prices can push substitution. High prices can increase recycling. High prices can lead to brutal profit-taking. We already know that. Reuters said the Silver Institute expects jewelry demand to fall 9% in 2026 and silverware demand to drop 17%, with India leading that decline because high prices are hurting demand there. So yes, price solves some of its own problems over time. But again, even after you count those headwinds, the market is still projected to remain in deficit. That is the point. The bullish case does not require silver demand to be perfect across every category. It only requires that enough demand stays firm while supply remains slow and financial pressure keeps pushing people toward hard assets. That is a much lower bar than many people realize. This is why I keep coming back to the phrase possibility instead of certainty. Certainty is for people selling stories. Possibility is for people trying to read structure honestly. I am not here to tell you silver must hit a specific number on a specific date. I am here to say that when gold is already near $4,700, silver is around $73, the ratio is still near 64. The silver market is still in deficit, Banks like UBS are talking about $6,200 to $7,200 gold. The Fed chair says the debt path is not sustainable, and the CBO keeps showing giant deficits ahead. Then very large silver numbers belong in the conversation. And I know some people will still say, yes, but $700? So let's say it plainly. $700 silver is not my conservative case. It is not the calm scenario. It is not the easy scenario. It is the kind of number you get when a long cycle ends in a hard repricing of money, a strong gold move, and a dramatic compression in the ratio. It is the kind of number that sounds ridiculous before the system that made it ridiculous starts looking less stable than people assumed. Because remember, every big revaluation looks absurd early. Gold above $2,000 once sounded absurd. Gold above $3,000 sounded absurd. Gold above $4,000 sounded absurd. And yet here we are, with gold trading around $4,691.86 on April 6th. So the market has already been teaching the same lesson for a while now. What sounds impossible in one phase can become the new normal in the next phase, much faster than consensus expects. The real danger, in my opinion, is not that people imagine too much upside in silver. The real danger is that they assume the old framework will hold together forever, that the debt can keep expanding without consequence, that currency trust can keep weakening without hard assets responding, that industrial demand can stay large without supply eventually feeling the strain, that gold can re-rate while silver stays forever asleep. History usually does not reward that kind of lazy assumption. So how would I think about the next phase? Very carefully, very patiently, and without needing every day to look pretty. Because if silver is going to have its real move, it will probably spend time confusing people first. It will spike, shake out, reverse, scare, rip, and then do it again. That is how markets transfer assets from the impatient to the patient. It is messy on purpose. That is also why community matters more than people think. If you are serious about following this space, do not just watch passively. Be part of the signal. Use the comments section intelligently. If you see something that supports the thesis, share it. If you disagree, say why. And if you are one of the viewers who has done well, whether in silver, gold, business, investing, or life generally, share a little of that too. People draw strength from real examples. They really do. And for the people who want every update fast without waiting for the full upload, that is exactly why the WhatsApp channel matters. Use YouTube for the deep dive. Use the WhatsApp channel for the quick alerts, the fast reactions, the little shifts that matter in real time. They work together. One gives you the full map, the other keeps you from missing the turns. So where does that leave us? It leaves us with a silver market that is still small, still structurally interesting, still volatile, and still misunderstood. It leaves us with gold that remains historically strong. It leaves us with central banks still buying gold in large quantities. It leaves us with global debt still rising. It leaves us with the Fed chair warning the debt path is not sustainable. It leaves us with the Silver Institute still calling for another deficit year. And it leaves us with a ratio that still says silver is cheap relative to gold. If you put all of that together, then no, I do not think the silver story is over. I think it is still early in the bigger sense, even after the volatility, even after the scary pullbacks, even after the huge move already behind us. Because in a true long cycle re-rating, the first move gets attention, the second move gets participation, and the final move gets obsession. We are not at obsession yet, not even close. When taxi drivers, office workers, and people who never cared about metals start arguing over silver ratios, then maybe we can talk about late cycle. When every mainstream portfolio manager suddenly loves silver, then maybe we can talk about late cycle. When the people who mocked it are the loudest buyers, then maybe we can talk about late cycle. But that is not the mood right now. The mood right now is still mixed, still hesitant, still skeptical, and that usually matters. So yes, I think silver has the ability to shock people. I think it has the ability to outrun what most conservative models are willing to admit. I think it has the ability to make small changes in the ratio feel enormous on the price chart. And I think the people who dismiss large targets too quickly are often the same people who stare at markets through yesterday's rules and miss what is changing in front of them. That does not mean throw caution away. It means understand the game. Understand that volatility is part of the price of admission. Understand that headlines will try to shake you out. Understand that broad market weakness can hit everything for a while. Understand that silver can break hearts in the short run and still reward patience in the long run. Those truths can sit together. They are not contradictions. And that is really the point of this whole video. Not blind hype, not fantasy pricing, not pretending every week will be green. The point is to separate a wild claim from the structure that could eventually make it less wild than it sounds. Once you do that, you stop reacting like a spectator and start thinking like someone who is actually trying to understand how a repricing cycle works. So keep your eyes on the gold trend, keep your eyes on the deficit story, keep your eyes on the ratio, keep your eyes on industrial demand, keep your eyes on supply response, and most importantly, keep your emotions under control. Because if the bigger silver move really is ahead, emotional people are going to donate their positions to disciplined people all along the way. And again, if you have been doing well in your own life, in your business, in investing, or even just in the way you have stayed steady during chaos, put a little of that in the comments. That kind of signal helps more people than you think. A strong audience builds a stronger audience. Quiet viewers read that stuff, and sometimes one grounded comment keeps someone from making a bad emotional decision. By the time you finish this, go check whether the members-only video is already up, because that is where the full update stack is going to be sitting in one place. Join the membership if you want the deeper layer, because for premium members, we are going to keep pushing further into the numbers, the scenarios, and the in-depth analysis that does not always fit cleanly in the public video. And if this breakdown gave you clarity, do the simple things that matter. Subscribe to the channel, join the WhatsApp channel, leave a comment, even if it is just Our John AG. Those actions are small for you, but they are huge for the channel, and they tell the algorithm that this community values serious content instead of empty noise. Because the people who move early in a cycle usually do not look brilliant at first. They look weird. They look too early. They look too patient. Then the structure tightens. Then the narrative changes. Then the crowd arrives. And by the time the crowd finally understands the story, the easy part of the move is already gone. That is why I want you thinking ahead, not reacting late. Because if silver really is setting up for the kind of long cycle move that more and more signals are pointing toward, the question will not be whether the crowd was warned. The question will be whether you were paying attention when the warning still sounded unbelievable.